Hi everybody, Shawn Lucas here, head trader at the Apiary Fund. So good to be with you again on this Facebook Live. Always look forward to these opportunities. Today, we're going to be talking about stop losses, and this is a topic that you recommended, and so I'm happy. Like, if you have any comments, if you can hear me, if you can hear me, put your thumbs up. We're just checking the audio. We have a new audio set up. We're still learning how this whole thing works. If you can hear me, do a thumbs up or a like or something like that. Is it coming through all right? All right, sounds good. Okay, so this is a topic that you suggested. So this is, I am happy to do any kind of topics, well, within reason, any kind of topics that you have. Go ahead, type them in the comment box there. We're happy to address those. Get your questions answered. Focus in on the things that you want to hear. And I don't recall who. I should have jotted that down before the Facebook Live. Who recommended this? But we actually had a couple of recommendations to take a look at stop losses. So, with that, we're gonna jump right into stop losses. Stop losses. What are they? Basically, whenever you have an investment, right? Any kind of investment. It doesn't matter if it's currency, stocks, even a house or whatever. Real estate, whatever it is, there's a point in which you always want to stop any kind of loss, any kind of negative, returns that's happening. You want to just, at some point, you have to be able to get out of something. And that's hard. I mean, so many people have a difficult time closing out of something that they're losing in. And it creates all kinds of psychological issues. It's really difficult for us to admit that we're losing. But the problem is that if you're in the financial world, especially in the stock market and especially in currencies or anything high volatility like that, then you have to have the moxie, the gumption, whatever it is. You have to be able to pull that trigger and say, enough is enough, and I'm going to get out of this trade, or I'm going to get out of this investment. So we're going to talk a little bit about three different types of stop losses, especially for Apiary Fund traders. Now, Apiary Fund traders have a little bit different setup than most people, because Apiary actually monitors and manages any losing position. So behind the background of Apiary Fund is a system, and it's monitoring all the accounts. And the sole purpose of that system is to make sure that we don't incur losses that are greater than we can manage. So case in point, a few years back, there was the Swiss National Bank that decoupled from the Euro peg. And it created overnight created huge amounts of losses in the financial world, in the currency world. And fortunately, Apiary Fund's risk management system stepped in, saved the day, hero, Superman, right? Saved the day, and we were able to walk away from that Swiss National Bank debacle without having any significant losses. Nothing that we couldn't overcome, basically. So what are the stop losses that you should have? There's basically three kinds of stop losses, and I'm going to talk particularly to traders. Investors, you really only need one, but let's talk about the three types of stop losses. And we're trying something new with the whiteboard, so hopefully you can see that okay. The first type of stop loss is a hard stop. We're going to call it a hard stop anyway. Second type of stop is a soft stop. And then the third type of stop is for Apiary Fund traders, and this is obviously the risk management stop or the Apiary Fund stop. Apiary. Okay, so these three different types of stops you'll manage them differently. The hard stop, this is a stop that you place when you place the trade. So you're getting everything set up, you've identified your trade, you automatically put into that trade structure the stop loss. It's a hard stop. Basically, it's the point at which you're saying, I'm not going past this. If this is going against me, if I'm wrong, I'm just not going to let this hurt me any more than that. Okay, so this is a manual, or it's not a manual, it's an automatic set stop that you enter into your trading platform. A soft stop, on the other hand, is something that you manage. Okay, so imagine that you have maybe a 10 pip hard stop on your trading platform. So if the market goes against you 10 pips, it'll automatically close you out of the trade. If I'm monitoring that and I see that the trade is going south on me, if I see that momentum is turning, if I see different things about how that trade's developing, well, then I might get out with a soft stop. It's more of a manual intervention, right? I don't know how many of you are able to come watch the trading room at Apiary Fund. So when I'm trading in live market conditions, every single trade that I place will have a hard stop. Every one of them. It's programmed into Albio. It automatically triggers. I don't ever have to think about it. There's a hard stop in there. But if you look at 10 trades that I place, almost out of 10 trades that I take a loss on, that is, out of 10 trades that I take a loss on, probably 9 of them I'm getting out with a soft stop. This is something that I'm just saying, okay, things aren't quite adding up right now. I'm just going to get out of that trade. So it's more of a manual intervention. And my goal, this is just me personally, is I don't ever want to have my hard stops trigger. I don't ever want to have my hard stops trigger. I want to know before that hard stop triggers, I want to know that I can get out of that trade, or that I'm astute or aware enough of that, of what's happening, to just get out on my own. And then the third stop is the apiary stop. Now I'm just gonna say it how it is, folks. If you're getting stopped out with the apiary stop, then you've got to fix something in your trading, right? This is the last line of defense. This is the I am literally falling off the edge right now, and this is my safety harness stopping me from dying. Okay, that's the way I want you to think about the Apiary Fund stop, is because we really aren't. Our job as the fund is to give you enough flexibility in the trade to work things out, right? But we're expecting you to work things out both with your hard stop and with your soft stop, preferably your soft stop first. Say that 10 times. All right, so hopefully you kind of got a feel for how we look at, or how I look at stops. These are 3 different types of stops. Want to make sure that you're using them. All right, the next thing we want to move to is, how do you know where to put your stops? So one of the first things that I do when I'm trading is I try and get a feel for volatility in the market. So imagine if I'm comparing one trading session or one period of time to another period of time, I might see volatility something like this in one period, right? And then I might see something like this in another period. Okay, so clearly if you just anecdotally look at and compare the 2 different market conditions, this period over here to the right, I think you're right, this market condition is a little bit more volatile than this market to the left, right? And so what you'll want to do is you'll want to expand or contract the size of your hard stop. So hard stops here, contract, So instead of a 10 pip stop, instead of a 10 pip hard stop, you'd put a 3 pip hard stop. So how much you're giving the market shrinks, right? There's no need to give it 10 pips because the volatility is low, right? And then over here, your hard stops expand. So with higher volatility, you want to give it more. So instead of a 10 pip, maybe you're giving it 15 pips over here. Now this also applies to what time frame you're on, right? So if I'm using a 3 pip stop on a daily time frame, not really going to be a smart stop. So time frames will also increase. Higher time frames require bigger stops. Smaller time frames require smaller stops. So that's the second lesson for the day. Look at the volatility and look at the time frame and expand your stop losses with higher time frames and higher volatility, and decrease your stop losses with smaller time frames and smaller volatility. Hopefully that just makes common sense, right? All right, so that's the next thing. The third thing regarding stops is to place the stop on the right side of the fence. Okay, what do I mean by that? So let's assume that you have a market that has formed a support level there, right? So that support level, you can think of that as the fence. Some people call it a floor, some people call it resistance level ceilings, whatever it is, let's just call it a fence, okay? So if I'm getting into a long position right here, if I'm thinking that the market is going to go up, where do I place my stop? Well, a lot of traders just put some random stopping points. They put the hard stop in at some random number. They say 6 pips. Well, 6 pips could be here, or it could be here. So if that 6 pip stop loss lasts there, well then you've got a problem, because if the market decides to fluctuate before taking off, then there's a chance that you're going to get stopped out, but because your stop is on the wrong side of the fence. The stop has to be on that side of the fence if you're getting into a long. So use your support and resistance levels to identify where your fence is, and then make sure your stop is on the opposite side of the fence. The other challenge is you don't want it too far away from the fence, right? So if your stop is here, well, you've got all of this distance that is unnecessary loss, right? Because whether you get stopped out there or whether you get stopped out there, this is all free falling until you find your next fence, right? So if your next fence is down here, then you're just expecting the market to go from this point down to that point. So there's no sense in putting a stop loss in the middle, in between your fences. Line those stop losses up close to the fence. Make sure that the stop loss is on the right side of the fence. Again, just think through that. It just makes common sense. Hopefully hopefully this has been helpful. Hopefully, any questions that you have, let me just kind of monitor real quick. Any questions? We've covered 3 things today. Number 1, using your stops, right? There's 3 types of stops: a hard stop, soft stop, and for Apiary Fund traders, there's the Apiary stop, right? Apiary stop is it's a save my life type of a stop. I know some of you come in, and I know some of you, not going to name any names, but I know you, some of you use the Apiary stop as your stop. It was never intended to be that way. The purpose for that Apiary stop is to give you flexibility in the trade, allow you an opportunity to manage your positions. Okay, The hard stop, you always put a hard stop on your trades, no matter what. You need that. It protects you, right? But most of your trades should be getting out with a soft stop. So that's the first thing we learned today. Second thing we learned today was the volatility and this idea that you expand your stops for higher volatility and you contract your stops for smaller volatility. You're just trying to match the volatility in the market. As it gets big, or if you're on higher time frames, you need longer stops. If it's short and on smaller time frames, use smaller stops. There's no sense in risking multiple losses or getting stopped out multiple times because you haven't matched the volatility in the market. So that's a key point. And then the final thing is to make sure that your stops are on the right side of the fence. So if you're using, some fixed stop level like 12 or whatever, 10, make sure that you go in and adjust it and make sure that it's sitting close to the fence on whatever the right side is. So if you're long, you want your stops below the fence. If you're short, you want the stops above your fence.
Jean asks, please discuss the trading stop feature.
Trading stop feature. I think in Alveo, trailing stop or trading stop?
Probably trailing stop.
Trailing stop, okay. Well, we'll answer both, right? We can do both.
Stop.
It's trailing stop.
See it with her.
A trailing stop, basically, that's a different type of stop. Basically, it's going to follow you. So you think of a dog, right? When I was a kid, I had a dog, and when I'd go out, the dog would follow me. He would follow me everywhere I went, up the mountain, down the mountain, out to the pastures, out back from the pastures, wherever. So basically, you think of the trailing stop as your little dog, and as the market goes up to a point, that stop loss will follow you. So it'll stay some distance behind you. So if we're at that blue dot, and this is our trailing stop, if the market continues to move higher to there, then your stop would stay that same distance behind you. Now the idea behind a trailing stop is it never goes down. So if this market turns and moves lower, then it will not follow you. It will stop you out. And so really the idea behind a stop loss or a trailing stop is to allow you to capture long trending markets, right, with low volatility. If volatility is high, your trailing stop needs to be wide. Same principle that we talked about earlier. High volatility, wider trailing stop. Lower volatility, smaller trailing stop. But the purpose is to let that market run. Good question. Thank you. One more?
Yeah, one more. Thomas asked, what exactly do you mean by a soft stop?
A soft stop, good question. The question is what do you mean by a soft stop? A soft stop is you intervening into the trade. So a hard stop is the system does it. You enter the hard stop into the system, it manually puts an exit point in the market, and you can change that exit point, but whenever it's triggered, the system triggers the exit, not you, right? A soft stop means that I'm going to trigger the exit. So if I see, for example, that the market is, I'm watching it move into a bullish trend here, for example. And so I trigger into the trade here, but all of a sudden I see a consolidation form, something like that. Well, my stop may be on the other side of the fence down here, right? That may be my stop. But why would I hold on to that and suffer all those losses if everything about that market has changed and now the move is going down, right? There's no need to hold on to that trade as it goes down. I can intervene and stop out of that trade right there, maybe book a little profit, maybe book a little loss, it doesn't matter. but I'm closing out of that trade, that's a soft stop. I'm stopping out because things have changed about the setup in the market. That's what I mean by soft stop. It's a manual intervention. It's you making a decision before it hits your hard stop. Good question. All right, I think we're good. I think we're definitely good. You don't want to listen to me anymore. It's so great to be with you. Look forward to tomorrow morning in the trading room. Always a fun opportunity for our traders to get together. Hopefully we get some volatility this week, and we have a good trading session in the morning. So join us for the trading room in the morning. Other than that, go ahead, answer or pop in any kind of suggested topics that you have or anything along those lines, and we'll...
We got one last question from Kent. He wants to know, where did you get that hat?
Where did I want to say somewhere really, really cool, like, I don't know, some gold mine in California or something like that. But truth is, it came from Amazon. So, anyway. Thanks, guys. So great to be with you. Wish you all the best of success in your trading, and look forward to seeing you next Wednesday, same time. Special Thanksgiving edition of our Facebook Live. Thanks, everybody. We'll see you.